All right, let's talk about fintech. Because it really feels like 2026 is the year the music stopped. That whole era of just endless hype and growth at any cost, yeah, that's pretty much over. Now a whole new, much tougher set of rules is taking hold.
So to really get what's happening, we're going to look at three completely different companies. We're talking an industry giant, a super popular challenger, and, well, a quiet power player working behind the scenes. On the surface, you'd think they have nothing in common. But trust me, when you dig in, they're all singing the same tune. It's all about durability now, not just hype. You know, for years, fintech felt like this massive, non-stop party, right? The money was easy, and the mantra was just grow, 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 no matter the cost. But what happens when the party's over? That is the huge question the entire industry is grappling with right now.
Okay, let's start with the titan of the industry, JPMorgan. Now, you might think a company this huge is, above the fray, but oh no, they are deep in this fight. And their strategy, well, it shows you just how incredibly high the stakes have gotten.
Think about it. For decades, JP Morgan's main competition was other giant banks. Same old playbook. But today, the threat looks completely different. It's coming from hundreds of these small, fast-moving fintech startups that act more like software companies. Even JPM's own leadership is admitting that the entire bar for just competing has been raised.
So what's their move? They're actually choosing to spend more, way more. They're just pouring cash into technology, AI, and data infrastructure. Now, to an old-school investor, rising costs might look like a huge red flag. But the bank's message is pretty clear. This is a deliberate investment to avoid becoming a dinosaur. This is the cost of staying relevant.
And get this spending isn't for some flashy vanity project. It isn't even really about growth, not in the old sense. For the world's largest bank, throwing billions at tech is now simply the price of admission to the future of finance. It's not optional anymore. It is survival.
So we just saw the giant playing defense. Now let's flip the script and look at a high-flying challenger that just discovered gravity, eToro. This is the other side of the reality check. It's what happens when the promises of a hot IPO meet the cold, hard math of the public markets. I mean, just look at this journey. Only a year ago, back in May 2025, eToro went public on this massive wave of retail investor hype. It was a huge deal. But fast forward to today, and the story has completely flipped. The company's stock is hitting all-time lows, and they're cutting jobs. The challenge isn't about riding a wave of momentum anymore. It's about proving the fundamental business model is actually sound.
And here's the real heart of the problem for companies like eToro. When you're a private company, you can sell a story based on vibes, partnerships, momentum, brand recognition. But the second you go public, the market demands math. It wants to see margins. It wants to see cost discipline. It wants a clear path to profitability. The whole scoreboard just changes.
The crucial takeaway here is that an IPO is not the finish line. It's the starting gun. For eToro, the game has now totally shifted from offense to defense as they try to prove to a pretty skeptical market that their model can actually withstand the pressure. Now for our third and final story. This is the one you probably haven't seen in the headlines, but it might be the most important one of all. Let's talk about the quiet power of the financial world's essential plumbing and a company called the Bancorp.
So what on earth is a sponsor bank? Well, it's a really simple but powerful idea. These are the federally regulated banks that provide the license foundation that lets a fintech company, like Chime or other neobanks, actually offer financial products. They are the invisible, regulated backbone of the entire industry.
Yeah, sponsor banks handle all the unglamorous nuts and bolts work. We're talking managing the issuing of cards, holding deposits, and, most importantly, dealing with the super complex world of compliance. It's the kind of work that doesn't exactly trend on social media, but without it, no fintech app can even operate.
And this right here, this is the key insight. The flashy fintech brands get all the attention. They move fast, they build cool apps, but the real leverage, that's held by the sponsor banks, like the Bancorp. And they're quietly reminding the entire industry that they're the ones who decide just how far and how fast those challenger brands can really go. So, we've seen the incumbent, the challenger, and the infrastructure player. Let's pull all this together and see what these three very different stories tell us about the future of finance. It really all comes down to this. JP Morgan is spending billions, reminding us all that survival now requires massive upfront pain. eToro's struggles after its IPO show us that the public markets value discipline way more than they value hype, and the Bancorp's quiet power proves that the most durable leverage is often hidden away in the essential infrastructure.
This leaves us with a final, really crucial question. As we look to the future of finance,
Where is the real power going to lie? Is it going to be with the slick, user-friendly app on your phone? Or is it with the regulated, often invisible bank that's quietly holding everything together behind the scenes? It's a question that is absolutely going to define the next decade of finance.